What are assets and liabilities? Let's begin with a question that sounds simple, but has the power to completely change your financial future. Do you know the difference between an asset and a liability? Most people think they do, but many confuse the two, and that's exactly where financial trouble begins. So let's break it down in plain language. An asset is anything that puts money into your pocket. A liability is anything that takes money out of your pocket. That's it. That's the rule. Not what it's worth. Not what it looks like. Not what society tells you. If it adds money to your life on a recurring basis, it's an asset. If it drains money from you over time, it's a license. Let's take a few real-world examples. A rental property that brings in monthly rent, asset. A car you're still paying off that depreciates in value and needs gas, insurance, and maintenance, liability. Dividend-paying stocks that send you quarterly payouts, asset. A credit card with a balance, liability. Now, you might say, but my house is worth $300,000. Isn't that an asset? And here's where mindset shifts begin. If that house is your primary residence and it doesn't generate income, it's actually a liability, at least in the short term. Why? Because you're paying for mortgage, maintenance, taxes, and utilities every single month. On paper, it may be growing in value, but unless it's generating cash flow, it's not helping you build wealth yet. This is where most people, especially the middle class, go wrong. They acquire things that look like assets, but behave like liabilities. Understanding this basic distinction is the foundation of financial literacy. But knowing the difference isn't enough. Because what really matters is what you do with this knowledge. Let's now move a level deeper and see how the wealthy play this game very differently. How the wealthy think differently about money. We've all heard the phrase, the rich get richer. But how do they actually do it? It's not luck. It's not always inheritance. And it's definitely not because they work 10 times harder. It's because the wealthy understand one thing better than most: how to use money to buy assets, and how to make those assets generate even more income. Let's break this down. When an average person gets a raise or a bonus, what happens? They often upgrade their lifestyle. A bigger house, a new car, fancy clothes, or eating out more. But when someone with a rich mindset gets extra money, they ask, how can I make this money work for me? They don't just spend, they allocate. They channel their income into things like real estate investments, index funds or dividend-paying stocks, businesses or side hustles, high-yield savings or peer-to-peer lending. Each of these assets then creates more income, which they again reinvest, and the cycle continues. This is called the wealth flywheel. Every dollar they earn gets a job, not just to be spent, but to earn more dollars. And here's the most powerful part. They use other people's money too. Smart investors know how to leverage loans, partnerships, or credit to acquire assets that pay for themselves and generate returns. It's not about working harder. It's about thinking smarter. Whereas many people buy liabilities that look like rewards, the rich buy assets that become rewards later. For example, instead of buying a brand new luxury car, a wealthy individual might invest in a vending machine business that generates $1,000 per month, and then use that cash flow to lease the car. The car becomes a reward funded by an asset, not a drain on income. This mindset shift, from consumer to investor, is what truly separates those who build wealth from those who chase it. Now that we understand how the rich think about money, let's look at something even more eye-opening: how their cash flow patterns are completely different from everyone else's. Here's where things start to get really clear. When you map out the movement of money, from income to spending to saving, you can see how wealth is built or lost. Let's start with the cash flow pattern of someone struggling financially. Poor or paycheck-to-paycheck mindset. They earn an income. They immediately spend it on rent, bills, groceries, and consumption. There's little to no saving, no investing, no growth. Money comes in, and money goes right back out. Now contrast that with the middle-class mindset. They earn an income. They spend on liabilities that look like assets: mortgage, car loan, credit card payments. They might save a little, but investing usually comes last. In both of these models, money is primarily flowing away from the individual. Now let's examine the rich mindset and cash flow model. They earn income. They first allocate money to assets that generate cash. That cash flow then pays for expenses, or is reinvested. In short, the poor buy stuff. The middle class buy liabilities they think are assets. The rich buy income-producing assets. This pattern repeats over years and decades. The rich aren't just saving more. They're using their money differently from the start. They build a base of passive income, money that flows in regardless of their time or labor. It might start small, a $50 dividend, a $200 rental income, but it snowballs. Because as that passive income grows, it covers their expenses, giving them even more freedom to invest. The result? Time freedom, financial independence, the ability to choose. And it all starts with flipping the cash flow pattern. Understanding this pattern is like finding a hidden map that shows you how to escape the paycheck cycle. In the next section, we'll go even further. We'll look at common traps that most people fall into when trying to build wealth, and how to avoid them. Common mistakes people make when trying to build wealth. One of the biggest mistakes people make when starting their wealth-building journey is focusing only on income. While earning more is important, it's not the entire equation. Think about this. You can make $100,000 a year and still live paycheck to paycheck if you're spending all of it. On the flip side, someone earning $50,000 and investing wisely could end up wealthier in the long run. So what are these common traps? 1. Confusing income with wealth. High income does not mean financial security. If your expenses rise with your income, you're stuck in the same cycle, just with bigger toys. 2. Lifestyle inflation. Getting a raise? Instead of investing the surplus, most people upgrade their lifestyle. Bigger home, better car, fancier gadgets. This drains wealth potential instead of fueling it. 3. Ignoring or delaying investing. Many people think investing is something you do later, when you have enough money. The truth? The earlier you start, the less you need to invest monthly. Time is the real secret weapon. 4. Taking on unnecessary debt. Debt for an appreciating asset like a rental property? Strategic. Debt for a brand new $40,000 car that loses value the moment you drive it off the lot? That's financial quicksand. 5. Not tracking expenses or net worth. You can't improve what you don't measure. Tracking your cash flow and net worth over time gives you control. It's like using GPS on your wealth journey. Most of these mistakes aren't made because people are careless. They're made because we were never taught this in school. That's why financial literacy matters. But it's not all doom and gloom. Because once you recognize these traps, you can avoid them, and even reverse course. So what's the next step? Let's now talk about how you, starting today, can begin building assets, even with a modest income. How you can start acquiring assets today. You don't need to be rich to start buying assets. You don't need $50,000 in savings. You don't need a finance degree, and you definitely don't need permission from anyone. All you need is clarity, consistency, and a long-term mindset. Here's a simple roadmap to begin accumulating assets. Step 1. Audit your cash flow. Where does your money go each month? Create a breakdown of income versus expenses. You can use a free spreadsheet or budgeting app. Look for areas to cut back: subscriptions, dining out, impulse purchases. Freeing up just $100 a month can go a long way over time. Step 2. Build a small emergency fund. Before investing, it's smart to set aside 3 to 6 months of essential expenses in a high-yield savings account. This protects you from dipping into investments when life throws curveballs. Step 3. Choose a beginner-friendly asset class. If you like stocks, suggesting, look into index funds or ETFs, low cost and diversified. If you want passive income, suggesting, consider REITs, real estate investment trusts. They pay regular dividends. If you prefer control, suggesting, a side hustle that can grow into a business. If you're cautious, suggesting, peer-to-peer lending or bonds. Step 4. Automate your investments. The easiest way to build wealth is by removing decision fatigue. Set up automatic transfers on payday. $50, $100, even $20 is enough. It's about building the habit. Step 5. Keep reinvesting the returns. If you earn dividends or profit, reinvest it. Let compound growth work its magic. Over time, those small gains snowball into something substantial. The key here is consistency, not perfection. You'll make mistakes along the way, and that's okay. What matters is that you're moving forward with a strategy. Which brings us to the final and perhaps most underrated part of this entire process: the power of small asset-building habits over time. We live in a world that celebrates overnight success, viral videos, crypto millionaires, big lottery wins. But that's not how true wealth is built. Wealth is built slowly, quietly, and consistently. And the most powerful habit you can build? Automating small steps that accumulate over time. Let's take an example. If you invest $100 a month in an index fund with an average annual return of 8%, in 30 years you'll have over $135,000. That's not magic, that's math. If you invest $300 a month, it's over $400,000. And if you start early, even better. These small monthly steps that feel like drops in a bucket become tidal waves when paired with time and discipline. It's the same for acquiring real estate, starting a business, or even writing a book. One move a day, one piece at a time. This is the rich person's mindset. They aren't obsessed with flashy wins. They're obsessed with systems and habits that work over decades. So ask yourself, what habit can you begin this week? Opening a brokerage account? Setting up automatic deposits? Reading a personal finance book? Tracking your spending? Even the smallest action matters, because wealth isn't built in a single moment. It's built in the quiet choices you make, day after day. If you found this video helpful, consider hitting subscribe. I make more content that helps you take control of your financial life, one smart decision at a time. Until next time, stay aware, stay prepared, and let your money work as hard as you do.